Chapter 2: Financial Market. A financial market is a place where people buy and sell financial assets like stocks, bonds, and currencies at prices set by demand and supply. The word financial means related to money. Market means a place for buying and selling. It connects people who have extra money with businesses and people who need money, all on one single platform. Prices of assets are automatically decided based on how many people want to buy or sell at any given moment. For example, when you buy a share of TCS on the BSE, you are directly participating in a financial market. Structure of financial markets. 1. Money market deals with short-term instruments with maturity of less than 1 year. Example, treasury bills, commercial papers. 2. Capital market deals with long-term instruments with maturity of more than 1 year. Example, stocks and bonds. 3. Primary market, a part of the capital market where new securities are issued and sold to the public for the very first time. 4. Secondary market, a part of the capital market where already issued securities are bought and sold between investors on the stock exchange. Role of financial markets. 1. Transfer of resources. Money moves from people who have extra funds to businesses that need it, so no money sits idle in the economy. 2. Growth in income. When you lend or invest money, you earn interest or dividends. This grows your personal income and the country's national income. 3. Capital formation. Savings of millions of people flow through financial markets into new factories, machines, and infrastructure, building the country's wealth. 4. Price discovery. The price of every share or bond is decided here through the live interaction of buyers and sellers at every single moment. 5. Sale mechanism. If you ever need cash urgently, you can sell your investment in the financial market without having to wait for it to mature. 6. Information availability. All investors get access to the same market data and prices, so they can make smarter decisions about where to put their money. Importance of financial markets. 1. Efficient capital allocation. Financial markets ensure your savings reach businesses that actually need money to grow, create jobs, and serve the economy. 2. Liquidity. If you have invested money and suddenly need cash, financial markets let you sell quickly and get your money back without waiting. 3. Risk management. Financial markets give businesses tools like derivatives to protect themselves when prices of currencies or commodities change suddenly. 4. Economic growth. When idle savings are invested through financial markets, more businesses grow, more jobs are created, and the whole country benefits. 5. Encourages innovation. Startups and new businesses can raise capital through financial markets, which lets them build new products, technologies, and services. 6. Global integration. Financial markets connect India to the world, allowing foreign investors to invest here and Indian companies to raise global capital. Functions of financial markets. 1. Transfer of resources. Financial markets move surplus money from lenders to borrowers so funds are always flowing productively in the economy. 2. Productive use of funds. Borrowers invest the funds they receive in new assets, increasing production, income, and the standard of living for everyone. 3. Price discovery. Buyers and sellers coming together in the market decide the fair price of every share, bond, and financial asset traded there. 4. Liquidity. Investors can sell their financial assets at any time and get cash, so they are never stuck holding an investment forever. 5. Provides funds to borrowers. Companies and governments can raise money through financial markets to fund their projects without needing a single private lender. 6. Reduces search costs. Without financial markets, you would personally search for a buyer or seller. The market brings everyone together, saving time and money. Types of financial markets. 1. Capital market, where companies and governments raise long-term funds above 1 year through stocks, bonds, and debentures. 2. Money market, where short-term borrowing and lending happens for less than 1 year through treasury bills and commercial papers. 3. Foreign exchange market, where different currencies are bought and sold to support international trade and cross-border investment. 4. Derivatives market, where instruments like futures and options are traded. Their value comes from an underlying asset like a stock or commodity. 5. Commodities market, where raw materials like gold, oil, and agricultural products are bought and sold in spot and futures segments. 6. Insurance market, where individuals and businesses buy insurance products to protect against financial risks like health, property, and life. Money market. The money market is a market where short-term borrowing and lending happens for a period of 1 year or less. The word money here means highly liquid short-term instruments. Market means a place for buying and selling. It helps businesses, banks, and the government manage short-term fund needs quickly and without going through long processes. It also allows the RBI to control how much money is flowing in the economy at any given point in time. For example, when a company needs money for just 60 days, it can raise it quickly through commercial papers in the money market. Objectives of money market. 1. Parking place gives businesses and banks a safe place to put extra money for a short time and earn a small return instead of leaving it idle. 2. Overcoming deficits. When a business or government is temporarily short of funds, the money market lets them borrow quickly to bridge that gap. 3. Regulate liquidity. Allows RBI to control how much money flows in the economy by adding or removing funds through money market operations. 4. Reasonable access. Make sure that anyone who needs short-term money can get it quickly, easily, and at a fair interest rate without delays. 5. Equilibrium mechanism. When some banks have too much money and others have too little, the money market automatically balances them out. 6. Focal point for RBI. Serves as the main channel through which RBI puts its monetary policies into action and reaches all banks at once. Importance and functions of money market. 1. Financing trade helps exporters and importers get immediate funds through bills of exchange, so they do not have to wait for payment to arrive. 2. Financing industry. Industries borrow short-term funds from the money market to buy raw materials and manage their daily operations smoothly. 3. Profitable investment. Banks invest their extra funds in safe short-term instruments, earning interest without losing the ability to repay depositors. 4. Self-sufficiency of banks. In an emergency, banks recall short-term loans from the money market instead of borrowing from RBI at higher interest rates. 5. Help to central bank. Helps RBI track banking conditions and quickly spread the effect of its monetary policy decisions to all banks in the country. Types of money market instruments. 1. Treasury bills issued by RBI on behalf of the government for 91, 182, or 364 days. Very low risk and ideal for short-term investment. 2. Commercial papers, unsecured short-term notes issued by large companies to raise money quickly without needing to take a bank loan. 3. Certificate of deposits, issued by commercial banks to raise short-term funds from investors for a period of 3 months to 1 year. 4. Repurchase agreement, repo. A bank sells securities and promises to buy them back within 14 days, used for short-term collateralized borrowing. 5. Reverse repo. The opposite of a repo, a bank buys securities and agrees to sell them back, earning a return on otherwise idle cash. 6. Intercorporate deposits, ICD. One company lends surplus money to another company at a higher interest rate for a short period since no collateral is given. Players of money market. 1. Reserve Bank of India, the most important player. RBI regulates the market, controls liquidity and interest rates, and issues treasury bills for the government. 2. Government, the largest borrower. It raises funds to cover budget deficits through treasury bills of 91, 182, and 364 days maturity. 3. Commercial banks. They lend and borrow short-term funds daily and have a major influence on interest rates and liquidity across the market. 4. Corporate firms. Companies raise short-term working capital by issuing commercial papers with maturity ranging from 7 days to 1 year. 5. Discount houses and primary dealers act as middlemen, discounting bills and helping RBI develop an active secondary market for government securities. 6. Money market mutual funds collect money from investors and put it in safe short-term instruments to preserve the principal and earn a modest return. Limitations of money market. 1. Absence of integration. The organized sector under RBI and the unorganized sector of moneylenders operate separately with no real connection between them. 2. Multiple interest rates. Too many different interest rates for lending, borrowing, and government activities create confusion for investors in the market. 3. Insufficient funds, low income, low savings, and poor banking habits among many Indians mean there is always a shortage of funds in the formal market. 4. Shortage of investment instruments. The number of available instruments is still not enough for the size of India's huge population and rapidly growing economy. 5. Lack of organized banking system. High NPAs, big losses, and poor efficiency in many Indian banks seriously weaken the overall functioning of the money market. 6. Less number of dealers. Very few mediators exist between the government and banking system, making it slow for lenders and borrowers to connect. Capital market. The capital market is a market where businesses and governments raise long-term funds through stocks, bonds, and other securities with maturity of more than 1 year. The word capital means money used for long-term investment. Market means a place for buying and selling. It consists of development banks, commercial banks, and stock exchanges that connect those who need long-term funds with those who want to invest. It is divided into the primary market where new securities are issued and the secondary market where they are later traded among investors. For example, when TCS issues shares on the NSE to raise funds for its expansion, it is using the capital market. Features of capital market. 1. Long-term investment deals with securities like stocks and bonds with maturity above 1 year, making it perfect for companies with big long-term plans. 2. Primary and secondary markets includes the primary market where new securities are issued and the secondary market where those securities are traded among investors. 3. Liquidity. Even though securities are long-term, investors can convert them to cash anytime by selling on the stock exchange in the secondary market. 4. Market regulation. SEBI regulates the capital market to make sure all transactions are fair, transparent, and that investors are always protected. 5. Risk and return. Higher risk instruments like equity give higher potential returns, while lower risk instruments like bonds give lower but stable returns. 6. Economic growth channels savings into productive investments, which creates jobs, builds infrastructure, and contributes to the country's economic growth.